Chapter 1: Financial Management Function. For every paper in ACCA, it is very necessary that candidates step foot into the role required by that particular subject. In this financial management paper, you must think, understand, and analyze all concepts and situations like a finance manager of a company. This will also help in building professionalism while responding to situations that arise in an exam. To begin with, let's understand. What is financial management? Financial management is concerned with the efficient acquisition and deployment of both short and long-term financial resources to ensure the objectives of the enterprise are achieved. There are two main divisions to the above statement. Number 1. Take different decisions. Number 2. Ensure the objectives of enterprise is achieved. Hence, financial management can be said as taking various decisions with the view that it is ensuring the objectives of the enterprise is achieved. Let us look this into more detail. What are the key areas in which decision has to be taken? Let us understand it in a cyclical order. Number 1. Investment decision. This is about finding the various investments available such that the enterprise can grow and choosing the best investment option among the various availabilities. This can be said as long-term investments. For example, new projects, different industry and companies. Apart from this, funds have to be invested into their own company for the purpose of day-to-day running of business. These funds are called working capital or short-term investments. Number 2. Finance decision. To do the various sort of investments, funds are required for the company. This decision is about finding the various sources of finance available for the company and raising it in such a manner that the cost of capital for the company is not too high. Cost of capital is only a reference point for choosing the finance mode, because in practical world, always aiming for lowest cost of capital isn't applicable, as there are various other factors that also contribute to the financing decision making. Number 3. Dividend decision. Now that the funds have been raised from different sources, this decision is about choosing how much returns have to be given to these finance providers. Dividend in its proper meaning indicates the returns to finance providers, but returns to debt providers, interest, can't be decided as it is fixed and must be paid. Hence, the dividend decision here is about choosing the returns to equity, investors or shareholders, dividend, as these are flexible for the finance managers to decide upon. Therefore, the decisions of finance management can be represented through a flowchart as below. Debt, equity, finance, a company, working capital, investment in non-current assets, dividend. The financing decision, sources of finance, cost of capital, capital structure, risk. The investment decision, investment appraisal, working capital management, risk. The dividend decision, business valuation, efficient markets. The second part of the definition says about making decisions in such a way that it ensures the objectives of the company is achieved. What is the relation between objectives and strategy? Strategy here means the decisions taken as part of financial management. This can be well explained with an example of expansion of business. Number 1. Corporate level. This is the topmost level in a company. When a company plans on expanding their business into new markets, this becomes their commercial objective. Now, as part of financial management, we decide how to move into this new market, whether through organic or inorganic means. This decision becomes the corporate strategy. Number 2. Business level. At this stage, the separate business units within the organization competes on maximizing its competitive position within the chosen market. This may involve, for example, choosing whether to compete on quality or cost. Number 3. Operational level. At this stage, it is concerned about how the different functional areas within a strategic business unit plan their operations. The prime focus in this area would be the working capital management, which is investment in short-term capital. Financial objectives. The primary objective of every corporate company is shareholder wealth maximization. For this purpose, most companies set targets on the basis of: Number 1. Share price growth. Number 2. Dividend growth. It should be carefully understood that profit maximization is not what shareholder wealth maximization means. For example, Tesla's share price grew from an average of $4.67 in 2010 to $63.4 in 2018, without recording anything other than annual losses during this time. Hence, this shows that there is very less relationship between the share prices and profit figures. Concept checker. Since it is understood that they bear very less relation with each other, should a company focus on profit maximization alone with their objectives? The answer is no. There are a number of potential problems with adopting an objective of profit maximization. Number 1. Long versus short-run issues. It is very easy to gain high short-term profits and make the profit figures look great. This could either be through purposely cutting down expenses like training and quality products, which can boost the short-term profits but significantly cause a damage to the company in long run. On the other hand, short-term profits could also be boosted by means of manipulation and creative accounting. Using such tactics will be understood by the stock exchange and hence cause the share prices to fall. Number 2. High-risk earnings. It is said that the level of risk and returns from it are directly proportional. But this hasn't always practically applicable. For the purpose of boosting short-term profits, investments may be made in high-risk projects, which may provide profits for the short run and become detrimental in the long run. This move could cause the risk-averse shareholders to sell off their shares, and hence causes the share prices to fall. Number 3. Cash flow versus profits. Accounting profits are highly subjective to manipulation, but dividends are paid with cash. Hence, investors will consider cash flow with more priority than profit figures. This means that if profit figures are high and cash flow is poor, this may create a negative image and in turn cause the share price to drop. Maximizing versus satisficing. Terms to understand. Number 1. Maximizing. Seeking the maximum level of returns, even though this might involve exposure to risk and much higher management workloads. Number 2. Satisficing. Finding a merely adequate outcome, holding returns at a satisfactory level, avoiding risky ventures, and reducing workloads. Now you may have a question in mind. Why would requirements of some groups within a company be maximized and other be satisfied? Well, the next chapter would answer that doubt.